today, what we wanted to discuss very quickly is the Xero Cashflow features and tools that we can use within Xero. Okay, so our learning objective is we wanted to understand the usability of Xero Cashflow. Number two, what requirements we need to understand so that we can optimize the use of Xero Cashflow tools. Then there are things that we need to do before running cashflow reports or projections. Xero Cashflow tools, we need to know what are the different tools that are available in Xero. Mind you, it will actually be more than one tool we can use for cash flow. And then this is one of them. One is short-term cash flow, cash summary, zero budget, and indirect method cash flow report. So these are the 4 Xero cash flow tools. We'll discuss one by one all these tools. So let's try to understand what's the uses of Xero cash flow for us, particularly most importantly, when we are a cash flow based business. So these tools would definitely be a very good assistance for us in terms of insight, planning, and preparation. So the most obvious benefit we can use is the insight to short-term business cash requirement. This gives us an overview of what are the expected disbursements in the coming days, what are the planned collections in the coming days. We can also plan our cash requirement in terms of disbursement. We will have an overview of on what particular date we need to disburse this amount from our bank or our cash positions. Most importantly, if we have, based on our analysis, if our cash flow are short, then we can also prepare to source out additional cash to be introduced to the business. The Xero cash flow tools can also help us check completeness of cash balances. So for accountant, this is a very good tool to help us also finalize properly our cash accounts and bank accounts in our balance sheet. And of course, the importance of Xero cash flow report in our management report package to our business, which is part of our standard financial reporting. Other than balance sheet and profit and loss, we need to also provide for the cash flow report. And what is the best cash flow report that we can add for purposes of management reporting? Okay, so we need also to understand before we will going to start, what do we need to optimize the use of our cash flow tools, Basically, in terms of user, you can be a standard user with report access and an advisor. Number two, your Xero subscription must be any of the business edition plan. Now, short-term cash flow analytics, for each of the subscriptions, you would have the analytic plan, which is very basic. However, you have an option to upgrade it to Analytic Plus by paying extra $7 per month. This is free right now until January 2022. So this would give us more tools and features to optimize the use of our short-term cash flow tool. Things to do first. So before doing any cash flow work in Xero, we need to make sure, just a housekeeping, that you have added all your bank accounts as bank types in your chart of account. Very important. Number two, we recommend that your petty cash account must be set up in Xero as a bank type rather than a current asset account. Why? So that we would be able to include petty cash as part of our cash flow sources. So this would be included in calculating your ending cash balances in your cash flow report. Also, you need to do a bank reconciliation on a daily basis and make sure before running a cash flow report, you must have updated and completed your bank reconciliation. Then you need to update the sales invoice planned receipts. So if you have receivables, you need to add the planned receipts column of your sales invoice dashboard. Let me show you this one now very quickly. Okay, so here we are in your invoice dashboard. You need to fill up all this expected date collection. We'll do that later once we started doing the demonstration. And then we need also to do an update on expected payments. So here in our bills payment, under waiting for payment tab, there's also that plan date. You need to do plan date for all of that to complete all this date. Then you need to have a planned cash salary. So part of our process would be you would have a clear, at least a projection of your cash salary. Because what would happen in the basic cash flow reporting, it does not automatically add salaries, and the same thing with your tax payment. We need to add that in our projection. I will demonstrate that as well later. And then also add repeating invoices, repeating bills as well that can be considered as part of your short-term cash flow reporting. Now, zero cash flow tools. So here we have the first cash flow tools, short-term cash flow, cash summary, zero budget, and indirect. So I'll show you one by one now. So for zero short-term cash flow, you would see this one here in your business menu. It is basically an analytics tools which allow you to put in all your projected receipts and disbursements all together on a certain period of time. So what I would do, I would set up and select one bank account and then select the day that would be covered with our cash flow projection. And in our demonstration today, we are using the basic analytics tool and not the analytics plus, which we need to upgrade. So we are not upgrading in our demo today, and we will do a workaround on what needs to be done if you don't want to upgrade. So our demo for short-term cash flow would be just a simple analytics subscription. So we can add that. And then this is the initial short-term cash flow projection. Another would be the cash summary reporting. So the cash summary reporting would be in your report, and then it will be part of your financial report here. So this report is backward, not forward reporting, meaning it will display historical data of your cash flow. Unlike short-term cash flow report, that's forward, meaning projection. Cash summary would be one of those tools that we would see historical cash flow recording. So you can have this particular report if you want to see the history, how you spend and receive money in the past. Next would be zero budget. So zero budget is another tool. Okay. So this is our budget manager. This can be one of your zero cash flow tools that you can use. So this is an example of a cash flow forward, meaning again, like a short term, you can do projection as well here. Okay, where you can import, add cash flow based on your P&L chart of account. Basically a cash basis P&L account forward. And then of course, the last one, which is part of your standard management reporting, is the indirect method cash flow report. So it's also in your reports here. It's direct. Go back to zero. So this is our indirect method of cash flow reporting. Again, cash flow direct method is a type of cash flow that is historical based. Same with cash summary. So we can only see here not the forward looking cash flow requirement, but also historical as of September 30, January this year to here. So this is where we can get a direct method of cash flow. Now we'll go to that shortly. Now let's go to a demonstration for one by one. Let's start first with short-term cash flow report projection. So now for short-term cash flow, you have to understand again that there are two subscription levels on this. One is simple analytics, which is free for your regular subscription, but you have an option to upgrade from here. So if you want to upgrade, just click the company name and then go to the drop down and click Analytics Plus. Okay, so since this is a demo, I cannot add the trial here, but I will show you what is the difference later on an upgraded plus. Now, for purposes of our demonstration, we will use the simple analytic plan for our short-term cash flow demonstration because many of us would not want to add analytic plus. So this demonstration, we would just do the basic one. Now, first of all, you need to set up very quickly your short-term cash flow. Now, in this case, we already added the bank. So if you have multiple banks, including PT Cash, you need to add it from here. And then you would have to select the number of periods you would want to project. So do you want the next week or the next 30 days? Now later, when you are going to upgrade to Analytic Plus, you have more options until 90 days. But because this is a basic one, we will have only 30 days. Now, once we have set this up, and we're doing this the first time, the very first thing that we need to do is to make sure we need to complete our planned receipt, expected date of receipts of this invoicing. It's very simple to add. So just click the particular row of this invoices and then select the projected date where you would be able to receive this cash. So just click this down. I'll put 4, save, do also the other things. Let's say 5. So all your sales invoices that is overdue already or still due or have been issued, set that also in your expected date of payment. So I can do this very quickly now. And then here I will do 28, and then I'll do also 29 also here. And then finally this one. Now, I would suggest that every time you would create a sales invoice, okay, immediately add the expected date. Now, we're done for the first thing that we need to do. The second one would be to update also your planned payments. Simply go to your bills dashboard and make sure when you're doing this, you have initially entered all your basic bills for that particular period. If you're doing 7 days, that's for 7 days. But if you're looking at for 30 days, we need to add all these bills. So many of this would be accounts payable. Then let's add the date also when we are going to pay it. So just simply clicking the plan date column for each of these bills. Okay. Obviously, I'm just putting random numbers here, random dates. But when you are doing the actual cash projection, you have to put the realistic date. Now, I'm limiting my plan date in the next 30 days because we are doing only the basic analytics. Now, I'm done. So that's the second step. The third step is I have to make sure that all my unreconciled bank statement must be properly reconciled. So let's do a quick reconciliation of this demo. Now, what I would do, like how we are always doing it, we just basically clean up all those automatic matches. Okay, there's one more. And then what I would do, because I'm very used to doing this demo bank reconciliation, I can just simply quickly do bank reconciliation as it is. I can quickly close everything. Just find a big code. I need to update this, and then I do a split payment to update this payment. What else do I have? Then I have big amounts. I'll do prepayment, advance payment because there's no transaction on this. I'm just purely reconciling this, no? And then I'm just simply, do I have other areas here? Then there's another here. So owner, what I would do now is the rest I would do cash coding. So these are parking, and then these are travel. It's just why I love Xero. It's very easy to reconcile things. And then I would just simply do here, except for this one, which way bank. Yeah, fine. I'll just do office expense for all this, just to be very quick on reconciling. And then I have deposits here. I would just say this is coming from the owner funds introduced. They get exempt. And then I will do bank fees. This is bank fees. And then I reconcile the last line. Again, this would be advanced. So actually, I did this already before, but I don't know why it just removed all my reconciliation. So I thought that I have to do it again. Just an overpayment again. Now I completely reconcile, right? Now, that's step 3. The next step would be adding those, because we are doing the basic subscription here. And take note, what you have in Xero is your historical bills, meaning the bills that you have already issued that is incurred. So what happened in your cash flow, because you want to make sure, you want to cover, to project the future, it is important that you need to add other items that will show up in our projection after today. So if we're doing a cash flow of 30 days right now and we run it, that report is still incomplete. Okay, so before we go to the next step, just want to demonstrate to you, this is now what our cash flow would look like. So total invoices we owed to us, and then what we need to pay. By the end of 30 days, we would have $6,000 here. You can see one by one a breakout on a per week basis. And every time you click here, you would see those expected money that is going to be paid and the one that's incoming. And all these numbers are influenced in 2 things. One, what we have added in our expected receipts. And then number 2, those that we have entered planned payments. Now, another also information that the system Xero would add for us is Xero have its own internal algorithm where they would want to see your historical 3 months period, what are supposed to be expected expenditures in your bank, okay? So Xero would add initially all these items here. 1, all those that you have planned to receive collection. 2, those that you are expected to pay. Number 3, those Xero would add for you for your analytics, now based on internal algorithm of Xero using machine learning. Now, what you can do is you can just check one by one. Okay, so these were based on planned expenses, right? If you notice that, and then those positive ones, these are projected payments that we did earlier. Now, if you are not sure if this item should not be added, okay, you can edit this to a different date. That's what you can do. So those are the three things that would be initially be added in your short-term cash flow report. But as of now, we have already this projected cash flow in the next 30 days. Now, we need to ask ourselves, is everything complete this? Is all the information that we need for short-term cash flow are all completely entered in our system? The answer would be definitely no. Why? Because there are still things that you need to add. So example here, what I can say is, number one, the planned amount for your payroll is not being added here, right? Because the bills that we have created is basically your payables in the past. Number two, if you are planning to pay, let's say, contributions to government or, let's say, taxes, that is also not added here. But those numbers should really be added here to ensure we have a reasonable projection. Another would be possible future expenditures that is still on the pipeline, or possible revenue that you would be able to collect here on the next 30 days that is also not added here. So what do we do with that? Now, after we have done the 3 steps, completing your bank reconciliation, number 2, updating your planned payments for bills, and then updating your expected collections for your receivables, the next thing you need to do is to add those future expenditures in the next 30 days. How do you do that? Now, before I start this, I have to make sure that you are aware that the bills that we are creating here is purely projection amount. That can change later. So when you are creating these amounts that you need to be added in your cash flow in the next 30 days, be prepared that you have to come back to that later and edit or void that in case there's a new bill already that covered. That is the disadvantage of having a analytic subscription level of cash flow projection. So I'm just showing you the workaround now instead of subscribing to, well, the most convenient, of course, and recommended is to upgrade. But for our demo purposes, which many of our clients are not upgrading, just what we wanted to show now is the workaround for that. So the one workaround would be just to create the new bill. So let's say I would do payroll on the 15th, and my payroll would be 3,000. Of course, I'll do October 15 here. Salary, 3,000, wages. Okay, I'll approve that. And then I have 2 payrolls. Do another payroll. I edit this first. Now, what I would do, I normally say projection so that I can filter later and come back which all those items are just projection for purposes of cash flow. I do another payroll for the end of the month. Okay, again, that's also projection. And for example, I did to pay the government for tax. I'll create a new one as well. So let's say VAT, I would be paying that on the 10th, for example. I'll do 10th as well here. Again, noting that it's a projection, then I would say this is just VAT, and I would be paying VAT, let's say 1,000. Okay. You can add all other future expenditures in the bill, noting with a projection reference. You don't need to pay for that. Go back for the bills dashboard. And then, of course, you have to update the plan dates of payment so that that would be added in your projection. So here for payroll, that would be on the 29th. This would be on the 15th. And then this would be, let's say, on the 10th, right? I have added that already. Now, you keep adding all items that needs to be added for purposes of your projection. Now, in case, of course, that you need to plan, for example, to put more money later, let's not do that first. Let's just go back to your projection now. Your projection would tell us now this. Our projection is now updated. It's saying that we barely have no cash by the end of 30 days. And that's very dangerous. So now, it will prompt you, of course, to source out money outside. Either issue more invoices with the assurance that you'd be able to receive collections by this month, or the easiest way would be to plan to introduce more owner's funds to the business. So what I would do is to actually add this additional funds. So what I would do is, okay, I do invoice, and this time I need to create a projection invoice. Now, what you need to do is be careful because your system would be just generating an automated series. What I want you to do is just correct that and just say projection October 2021 001, right? Make sure this is not a official invoice. And obviously, you would need to use another branding here. I'll use very orange because that's not the official one, branded invoice. And then again, I would say projection also. Now, these are not best practice, by the way, but we are just talking about workaround, right? So owners cash. So new cash from owners. And then I would say they will have to contribute $5,000. And then I would say this is fund introduced. Again, you might ask, why am I doing this? I'm doing this because we are using the simple analytic subscription for short term. There is a better way of doing this by upgrading to Analytic Plus, where you don't need to create projected bills and invoices, but instead you would be able to use that feature. I will demonstrate that as well later. Now, let's go back now to your invoices. And then what I want you to do is, again, update the expected receipt. So I'm going to add this one now. I need 22, for example. So I'm adding that. What we have now, if you go here, we have now a projected cash flow. And then you have already created a projection where you need to add $5,000 by a certain period. That was it 25? So let's just view table now, right? Now let's do daily so that I will be able to see on the daily basis. Now, by looking at daily, you would see what are those incoming invoices and bills that you need to be paying. So here we have the VAT already added. Here we have the salary already added here. Owner's cash of 5,000 we have added already here. And then also your payroll on the 29 is all added here. To generate a proper cash flow projection short term, it is important that you have added all these transactions that are not in your current invoices and bills. This is now the result of your projected end cash balances by the end of 30 days. After you have made a reaction to adding a cash on the 22nd, 5,000, so that you will have a positive, right? Now, this is a dynamic projection, meaning every day you would need now to update whatever expenditures or future cash source requirement into your cash flow to get that insight. Now here, let me demonstrate to you the difference between a Analytic Plus. So I'll go to another demo. So here, so this is an Analytic Plus. Now, if you see the difference with our Analytic Plus, it allows us to expand to more days. That's the difference. Now you would know that this is a plus. Number two would be, instead of creating bills projection and invoice projection for your incoming cash, you don't need to do that, because here in our Analytic Plus subscription upgraded version, you just can simply add here. Let's say you need to put additional cash. So let's say owner's cash, example I did earlier. So is that money coming in? Yes, I'll just put 5,000 here and then I'll select 22, right? Then what happened on the 22, it's just added here. Now, what was the difference again? In our simple analytic short-term cash flow subscription, without the upgrade, we need to create a simple invoice. But in an upgraded plus, you just simply click the button here. Now, let's do also for your payroll. It's more easy, right? So like your payroll area, we said 3, and then the date we said it's 15. I add that, and then another payroll for the end of the month. So this is the better way and the best practice that we can do for short-term cash flow. Now, simply, it's already added in the system. That's why we recommend upgrading to a Analytic Plus. You would know that you have Analytics Plus by looking at this indicator, okay? Now, if you want to upgrade, it will be an upgrade here. Now, let's just go back to our demo to see that difference. So here, if you want to upgrade, you need to upgrade here. Now, our short-term cash flow is Analytics only. This is the upgraded one, which Analytics Plus, which you have to add $7 per month extra. So if you do not want to upgrade, you follow my procedure earlier. But if you want to make your life easier, you will do upgrade Analytics Plus for that, because you don't need to add all those bills. Now, why do we really recommend that you upgrade? It's because the risk of error in your books is high. Because what would happen here now, when you are closing the month, let's say October now, October 30, right? You need to go back to all these bills and you need to remove this already. You need to void one by one. So it creates a clutter in your invoices and bills, no, as voided invoice. So you need to void that invoices. So extra effort again. But that's fine because you're not upgrading. That is what we can expect on short-term cash flow projection reporting. This is a very good tool if you want to see your insight for the next coming days cash flow. Okay? Now, let's proceed to another short-term cash flow projection. Now, let me just clarify this. In Xero, I mentioned earlier, there is what we call projection reporting, and then you have this tool. This tool you will use for projection cash flow reporting. And then there is also what you call historical reporting. Projection in the sense you would want to project the cash flow requirement forward. So if you want that, then you can use short-term cash flow reporting or zero budget. If you simply want to see the performance of your cash flow on historical basis, just run the actual report for cash summary and direct method of cash flow. So I just wanted to emphasize that at this level. Now, let me go to zero budget now. So again, to do a zero budget, just to demonstrate, you can add a zero budget in Xero and be used as your cash flow tool to be able to have an alternative insight of your cash flow. Now, question, between the zero budget manager and the short-term cash flow, which do I recommend that we use? I strongly recommend we use a short-term cash flow reporting instead of zero budget. Now, here, in a separate webinar, we have discussed this on how we will complete this data. The very obvious difference, really, I would show you side by side. The very obvious difference here is that you need to fill up one field for each of this period, and the period is monthly. Okay, that's the number one difference. Here, your projection is more than 90 days. You're projecting forward on monthly basis. Unlike zero cash flow, you can project on daily basis, right? That's the advantage of short-term cash flow, because at a given point, we would know what are the items that you can see. And then you can also do like 7 weeks only reporting. You could have a micro reporting on cash flow level, because next 7 days, you can have 30 days, 90 days, 60 days. Here, you would need to input this in totals already on a monthly basis. And you can use this if for purposes of your budgeting, on your annual budgeting on your cash flow, right? Because, for example, today's October 1. This is the period where many management are preparing for budgets, right? So you can use this to generate cash flow budget. Now, so that's the first difference. It's monthly instead of daily. The second difference is that the way it will be presented for your cash flow is like a profit and loss or income statement method. If you can see, the way it is being presented is, this is actually a P&L method of creating a budget. Now, take note, Xero Budget Manager can be used for P&L budget and cash flow budget. So what I'm discussing now is that we can use Xero Budget for cash flow. So you can create a new budget, and then you would say this as 12 months cash flow budget, right? If you're creating budget for per tracking category, that's fine. But for now, we just leave it as one entity budget. So simply, I'm doing this very quickly right now. If you have a projection of 5,000, now let's say 10,000 revenue, okay, I'll just keep a fix of 10 for each. And then, no, this is interest income. I'm sorry. So if you have like 200 interest income, and then I have projected 10,000 of sales. Okay, I'm just copying this. Then your cost of goods sold, most probably 3,500 apply. And then all goes to the other things, 500. Your general expense would be 3,500. That's it. So then that can be your cash basis projected cash flow. But this is on the next 12 months, plus this is on monthly reporting. You can save that properly. So once you have saved that, I saved that already. Okay, and then I can export that into Excel. But now I have a budget already starting January 21 to December 31. Now this is the third difference between zero budget using for your cash projection is that if you're using Xero Budget Manager, so what you have is only a dashboard visibility within Xero. There's nothing here that you can actually export this report. Okay, so that's the third difference. Both short-term cash flow projection, like I said, and Xero Budget Manager, these are tools in Xero where you can use for forward numbers, future projection, future insight. Okay, now if we go back to our slide here, so the next is I would quickly demonstrate to you historical reporting cash flow tools, which is cash summary and direct method. Okay, now let's go to that. First, to find cash summary would be in your reports. And in your reports, you would see cash summary report here. Now, cash summary is a financial report within Xero, and it will report historical numbers that you have. Now, you have several options here. You can do monthly and then compare that to several months like what you do in the P&L. Maybe I'll do 11 months backward. You have an option to include payment for tax or not, or you can show year-to-date reporting for totals, or you can just simply, as an option, do average method also here. That's an option as well. Let me do average method first. So here what would happen is Xero would calculate for your last month. This is your cash basis performance, and then on the rest of the month, it will calculate an average and it will give you a variance analysis in terms of percentage. So what would happen is Xero would group them according to incoming and then to outgoing. And then you can have a different section for non-operating cash movements. And then also your tax movements will also show up also as another line. And here you would have performance overview of what was your opening cash in September. And then what is your net movement? Basically this amount, and then your ending cash balance here. Now take note, what would be included here are only bank type cash accounts. So that would include your bank account, and if you're adding petty cash as bank type, that transactions of those petty cash will be added in this report. Because this closing balance would show the breakup of the bank type summary. So when I click here, I would see all the bank's summary. One, what is open, what has been received, what has been paid, and what is closing. And again, take note, these are historical cash flow reporting. Now, in our example now, we have only one bank. But if you have multiple banks, it will break down all the banks, including your petty cash. Petty cash is set up as a bank type. Now, you can also run here a monthly report in the last 12 months. So it will reflect, since this is a demo, it will not show us all other transactions. So let me just show you this as 2 months comparison, right? It will meet 2 months, and then I can also choose to do show year-to-date totals. If you can observe, it's almost like a P&L, profit and loss or income statement format, right? The only difference is it's adding all those non-operating movements, meaning those non-P&L is added in this report. Okay, including what we paid and purchased for our assets will be added here. For your advances, it will also be added here. Your prepaids would also be added here as part of your non-operating movement. And it's not a simple P&L, because here, if you look at here from this point, it's look like this is your P&L basically, or cash basis P&L, profit and loss. But what is cash summary is different, is that it added also non-income statement accounts to generate for you a cash summary. Now, personally, I use this report to monitor the cash historical performance of my companies, how much I have spent for a certain months and what I have collected for a certain months. Okay, there are two methods where you can modify your report. One, which is the default, is the income and expense display methods. Here, it will show all your assets and liabilities will show up here. Your accounts receivable, your liability accounts, or the introduction of money from your owners, the purchase of assets. So this is the report where it's actually separating the P&L accounts from your non-operating movement, including the tax. But the default is when you're looking at operating expenses, you would notice that this account is added here in your operating expenses. That's an asset account, no? So it's not separating. Now, what I would do, I would prefer using non-operating movement. This is a best report because I would be able to segregate asset and liability accounts on another group and then separating all other P&L account. Right? So here, if you see income, you would see accounts receivable here in your income, right? So the income would be incoming cash. Operating expenses are incoming cash that's related for operations, and then separating the non-operating only for the fixed asset. But for non-operating movement, they completely separate the P&L accounts on the top, and then all other balance sheet account altogether grouped. So for me, this is the preferred method of reporting cash summary. Okay, so only here there's no projection, but it will tell us also only our historical performance. Now, the numbers that you will generate from here would help you also identify items that you might need to add in your projections. So when, for example, in the past, you have actually paid on a yearly basis like this, then it's not in your cash projection, then you have to manually add that in your cash projection. Now, unless, of course, it's a repeating invoice, then or repeating bill, Xero would actually capture that automatically as part of your projection. Okay, so that is so much for cash summary. Next would be, finally, the last report, direct method of statement of cash flow. So I would range my report from January to September. Okay, and then I'll update it. Now, this is a typical direct method reporting that we see in any of standard management report package. So they are separating the operating activities, which is the collection from customer, and then deducting whatever we paid, which basically from the bills, what we paid for our supplier. And then those that we actually receive from operation activities is also here. These blue lines are clickable. So let's say I'll click this, for example, and we will see the breakdowns of this in the report. So then you know what's the breakdown for that. Yeah. And then the same is true with all other links where you can click what's the breakdown separately. Now, investing activities, these are, of course, your purchases for your assets. And then if you're getting a loan, it will be under your financing activities as well. Or if owners are putting cash, will show up in your financial activities as well. And then here you would notice you would have net change as of that period. Now, let me go to cash summary report so that we can distinguish. Again, cash summary report and statement of cash flow direct method are reports that are historical cash flow reporting. Right? So let me just go back to September, and then I'll just do last 11. So September, that would be 8, right? So our number here, closing balance, is 8168. It's also the same as 816864. So they have similar ending cash balances, except that statement of cash flow are more reported on a summary based, which is the direct method. And the cash basis is based on chart of account amounts, right? Separating the P&L accounts and the non-operating movement accounts here. This is more detailed in terms of accounts. This is more summarized in terms of reporting. So in management reporting, this direct report can be submitted instead of this. But for internal operation, this is also a good method to see the breakout detail at one glance. Okay. Now, you can also compare that for certain periods. So let's say I would go back September again, and then compare previous months, let's say one period, right? So then I can compare the previous months as well, right? And then these are all exportable. You can both export. This one you can also export to Excel. Now, when you are preparing a management report package, let me just go back directly to management reporting. So here in the management report package, it will have executive summary, cash summary, profit balances, all these basic reports that you will submit to your report as an accountant. You would notice that what is added in your management report package is basically cash summary, right? So just an understanding, the cash transactions here that you see on the top in your executive summary actually are picked up from your cash summary report. And then when you're going to publish this report, it will include already your cash summary report. So let me just complete this now. So just to show you how this report package, including the cash summary report, is part of your reporting package. Update. Next is cash summary must be September as well, be consistent. And then also profit and loss must be September also. That's fine. Your balance sheet must be September as well. Your age receivable must be September as well. Then your payable is September. And then I would publish that and then publish. And then I can now download that report under publish. Okay. So I have published that report. And then I can also export that into PDF. Then I have a management reporting already, including my cash summary report. So your management report here, in terms of cash flow, will be displayed like this as a standard, depending on how you set up. No, it's almost the same as presented in your PDF. But if you are going to change that layout, that can also be done as well. Same thing, you can also switch, but take note the default would be income and expense. So this is now part of your management package. Again, in your management report, if you're using management report package, what it would show would be only the cash summary, and then your statement of cash flow would not be added to that. So if you need to present this, one of these disadvantages is that you need to export that separately. Okay, export that separately and add that together to your management report. Okay, so now let's go to the conclusion now. So let's talk about limitations. So in terms of limitation of short term, we know this already. So first is, of course, there are expenses like payroll and sales taxes that are not included initially. So you need to add that in your projection. The reporting would always be the base currency. So for example, your base currency reporting would be, let's say, US dollar. Your cash projection would always be US dollar. So even if your invoices is in euro or pounds, sterling pounds or Philippine peso, the reporting of your short-term cash flow would always be the US dollar if that is your reporting currency. Now, if you are not subscribed or upgraded to Analytic Plus, then you need to endure the pain of adding a projection bills and projection invoice in your sales and bills dashboard. This is a very bad limitation because it would add additional risk of error for you. So in case you forget, you're finalizing a report now and then you forget to delete and remove that later, void that later, that will be added in your report. So you have a misstatement in your management report. Obviously, if you're just using Analytic package, you need to make sure to void these projection bills and invoices before you finalize your management report. Now, cash summary, manual journal. This is one I need to tell you that for this cash summary, the amounts that will show up in your cash summary would include manual journals. Okay, so when you're creating a manual journal, this is a very important limitation. Okay, so example, you're using manual journal for creating prepayments and amortization. Now, the default when creating a manual journal, there's that portion here on the second line, or second row, says show journal on cash basis. If you have created a manual journal and tick this account, it will be include and post this. Any posting that show journal on cash basis will show up in your cash summary. Now, if you're using manual journal for recording amortization adjustment, what would happen is those amortization will be included in your cash summary. So be careful. What we wanted to do that the cash summary must only be cash basis and does not include accruals or amortizations that is not involved, and depreciation, of course, that's not part of our cash flow. Okay? Now, that's why when you are preparing manual journal, you make sure that when you're creating a manual journal, you have to understand what is this manual journal. Is this manual journal needs to be added in my cash summary or not? If yes, then I will tick this. Take note this is a default. If not, then untick this. Now, what are those manual journals that you need to untick? Examples would be amortization, okay? Accruals, if you're doing accrued expenses because you have not received the bill, you just need to accrue the account initially. So then make sure you have to enable that so that when you post the journal, it will be not added in your cash summary. So that is one very important limitation. In manual journals, you must uncheck show journal on cash basis for amortizations and all other manual journal adjustment that is not related to cash. Because what we wanted to show there is only transactions that are cash basis. Okay, make note of that. Now, in Xero budget, it's per month only. And then, of course, there is no opening and ending cash amount. So basically, you just look at the incoming cash and the outgoing projected cash for that particular month. Now, of course, which one is better? Better is the short-term cash flow because you can have a daily, okay, and it will show you the opening based on your cash account as of today. And then the ending cash would be the projected cash. Then finally, direct method cash flow. The limitation is that if you're doing a management reporting, it's not part of your management reporting package. So therefore, you need to export this separately and submit this as addendum to your management reporting package. Okay? So because my theory is that when Xero was creating initially the management report package, the only cash flow report, I think in 2014, no, 16, is only cash summary. The direct method cash flow reporting was not existing until I think 2016. But the management report, they did not modify that. But the standard management reporting, only the cash flow because that was the report available at that time. They did not include direct method cash flow. So that's the limitation. You need to export that separately and submit that as part of your management report.